Gold just hit $4,664, a 3-month high, and the market is flashing a major warning signal. The RSI is pushing 71, which is overbought territory. The last time we saw this level in January, gold corrected hard. But here's the twist. The Treasury buyback program is creating a completely different macro environment. I'm watching $4,700 as the next target, but $4,400 could be the correction zone. I've got the exact entries and exits in my full analysis. But here's the thing. The real tell is whether gold holds above $4,600 on the weekly close. Watch the full breakdown. Gold just hit $4,664. Let that sink in for a moment. Just 4 weeks ago, we were trading below $4,000, and now we are staring at a 3-month high with momentum that feels almost unstoppable. But here's what's keeping me up at night. The last time I saw this kind of vertical move in gold, it was January 2026, and we all remember what happened next. A brutal 25% correction that wiped out months of gains. Over the next 3 to 5 days, I believe gold is either going to punch through $4,700 in a historic breakout or collapse back to $4,400 in a violent shakeout. Welcome to Alpha Market Meridian. Today we are breaking down the fear architect that is gold, and I'm giving you the exact levels I'm trading from. Here's my bottom line. I'm bullish on gold in the medium term, but I'm deeply cautious about chasing this move at current levels. The RSI on the daily is sitting at roughly 70.5. That's overbought territory, and I've seen this exact setup play out enough times to know that chasing vertical moves is how retail traders get burned. My bias flips to bearish only if we see a daily close below $4,550. Below that, $4,400 becomes the next major target. The trap here is that everyone expects a pullback, and that expectation is exactly what creates the conditions for a continued melt-up. Comment below, are you buying this breakout or waiting for the dip? Let me start with what matters most this week, and it's not the chart, it's the macro story that's completely rewritten the gold narrative in the past 10 days. The single biggest catalyst for this rally was the US Treasury's surprise announcement on August 19th that it would expand buybacks of longer-dated government bonds. This move was described by the World Gold Council as monetary policy's version of plausible deniability. And they're absolutely right. The Treasury is effectively suppressing long-term yields while the Fed is stuck in a box. Hiking rates would make servicing $9.2 trillion in debt rollovers even more expensive. What stands out to me is not the headline buyback number, but the market's reaction to it. That's where the smart money is watching. The dollar dropped 0.8% following the announcement, and the 10-year real yield is now sitting around 2.43%. Here's the thing I've learned over 20 years of trading this market. Gold is increasingly decoupling from real yields. It's no longer just an interest rate trade. It's becoming a hedge against fiscal dominance and currency debasement. The calendar this week brings us the US GDP revision on Thursday and PCE data on Friday, both of which could add another layer of volatility. If the GDP revision comes in hotter than expected, we could see the dollar strengthen and gold pull back. But if the data shows the economy slowing, the debasement trade accelerates. Now let me show you exactly what the charts are telling me, starting from the monthly time frame because this is where the structural story lives. Gold has just reclaimed the $4,600 psychological barrier after breaking above the 200-day moving average at $4,501. The metal has surged over 11% in just 4 weeks, climbing from below $4,000 in July to today's $4,664. The weekly chart is showing a clean break above the 38.2% Fibonacci retracement level at $4,574, and we are now challenging the next major resistance zone. The RSI on the weekly is at a strong 65. Bullish but not yet flashing the extreme warning signals we see on the daily. The ADX reading is at 52.353. That's a powerful trend strength reading that tells me the momentum is real, dropping down to the daily chart, and this is where things get really interesting. The daily RSI is sitting at approximately 70.5. That's overbought territory, and it's flashing a warning signal that I cannot ignore. The last time we saw RSI this extended was in January, right before gold entered a major correction. But here's the nuance. Overbought doesn't mean reversal. In strong trends, assets can stay overbought for extended periods. The MACD is showing a powerful bullish crossover with the histogram at 23.830. That's confirmation that momentum is still firmly to the upside. The daily stochastics are at 78.298, which is also in overbought territory but still climbing. The moving average structure is absolutely textbook bullish. We are trading well above the MA50 at $4,594, the MA100 at $4,522, and the MA200 at $4,482. The MA5 at $4,673 is the only moving average we are below, and that's actually a bullish signal because it suggests we are in a pullback within an uptrend on the 4-hour chart. The structure is showing a consolidation pattern right at these levels. The pivot point for today is $4,666, with support at $4,657, S1, and resistance at $4,671, R1. The RSI on the 4-hour is rolling over from extreme levels, and the stock RSI is at 17.733, that's oversold on the 4-hour timeframe. This divergence is telling me that we could see a short-term bounce before any meaningful correction. The 1-hour chart gives us the tactical picture for the next 24 hours. We are trading in a tight range between $4,657 and $4,671, and the Williams %R is at -25.201. That's neutral and gives us room to move in either direction. The CCI is at 77.59, which is bullish but not extreme. Now let me give you the exact trade setups I'm looking at for this week. These are the levels I'm actually trading from, not just theory. Scalp setup 1. Gold, breakout continuation. This is a high probability scalp for the next 24 hours. Entry zone. Buy on a break above $4,671 with momentum stop loss at $4,657. Take profit 1 at $4,680. Take profit 2 at $4,700. Risk reward. Approximately 1 to 1.5 and 1 to 2 invalidation. Reclaim below $4,657 within 2 hours. The logic here is that we are consolidating right below resistance, and the momentum indicators suggest a break higher is likely. The key is to enter only on a clean break above $4,671 with increasing volume. The ATR is at 20.38, which gives us a reasonable stop distance. Scalp setup 2. Gold. The overextended fade. This is a contrarian scalp that plays the overbought conditions. Entry zone. Short from $4,680 to $4,690. Stop loss. $4,700. Take profit 1 at $4,657. Take profit 2 at $4,640. Risk reward. Approximately 1 to 1.5 and 1 to 2 invalidation. Daily close above $4,700. I want to be very clear about this setup. This is not for everyone. Fading a trend this strong requires conviction and discipline. The RSI is overbought, the stochastics are overbought, and we've had a massive run. But I've learned the hard way that overbought doesn't mean reversal. It means increased probability of a pullback. I'm taking this trade only if I see a bearish divergence on the 4-hour RSI and a failure to break $4,680. Swing setup. Gold. The big picture. This is a 3 to 5 day swing trade that catches the broader move. Entry zone. Buy on a pullback to $4,550 to $4,580. Stop loss at $4,500. Take profit 1 at $4,700. Take profit 2 at $4,764. Risk reward. Approximately 1 to 2 and 1 to 2.5 invalidation. Daily close below $4,500. This is my preferred setup because it aligns with the broader bullish thesis while offering a favorable risk reward. The $4,550 zone represents the breakout level that was previously resistance and is now support. If we get a pullback to that level, it's a high probability buying opportunity. Here's the reality check I give myself every time I see a market this extended. Position sizing matters more than direction. The RSI at 70 is telling me that the risk of a sharp pullback is elevated. I'm not risking more than 1% of my account on any of these setups individually, and I'm capping my total gold exposure to 1.5% of my account because of the correlation between the 3 trades. The biggest mistake I see traders make in markets like this is getting their direction right but their sizing wrong. They win the trade but lose money because they overpositioned on the edge. Let me tell you a quick story. Back in the 2022 gold rally, I was convinced the market was going higher. I was right about the direction, but I sized too aggressively on a pullback that went 3% deeper than I expected. I got stopped out, and then the market rallied another 10% without me. That lesson cost me $50,000, but it taught me something invaluable. Being right about the direction means nothing if you're wrong about your risk management. Always size for the worst-case scenario. Let me bring this together for you. The level to watch is $4,671 on the daily close. If gold breaks and holds above that, I expect a continuation toward $4,700 and eventually $4,764. But if we fail at $4,671 and break below $4,600, that's the signal that the overbought conditions are resolving to the downside, and we could see a move to $4,550 and potentially $4,400. I'll be back on Friday with a full recap of how this week's data reshapes the gold outlook. In the meantime, make sure to check out our Sunday weekly recap where we laid out the entire macro framework for all risk assets. Link is in the pinned comment, or if you're not already subscribed to Trade Meridian Decoded, hit that button now. We are the only channel that gives you this level of institutional-grade analysis without the corporate filter. Drop your questions in the comments below. What's your gold play at $4,664? Are you buying the breakout or waiting for the dip? I'll personally respond to the best ones. This is your host signing off. Remember, in this market, preparation beats prediction every single time. I'll see you on Friday.